All right, it's shaping up to be an ugly end to a very ugly quarter. 30 minutes until the official start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
All right, coming up, there's a sinking feeling in markets as the world waits for Trump's tariffs to be unleashed on Wednesday, and a critical jobs report looms on Friday. That comes as a roller coaster quarter for investors finally comes to an end. The S&P 500 is on track for its worst quarterly performance since 2022. And strategists don't really see things improving all that much this year. Goldman cut its S&P 500 target again, while RBC warns of a bear market below 5,500. All of that and more coming up. If you take a look at where we trade on futures, though, you can see that we're down overall on the S&P 500, off by about 1%. A lot of that pain is coming from big tech, and you can see that in Tesla right now. Elon Musk says that his role with Doge is costing him as at his main job as CEO of Tesla, citing political backlash. Shares are down 34% year-to-date through Friday's close. Musk has personally lost at least $100 billion, Chanel, and you can see shares down another 5% this morning.
Katie, I'm going to give you a little sampling of the pain in some other sectors here. You're looking at NVIDIA now down not as much as you saw earlier in the market, in the pre-market, but it is still down 3.3%. Of course, these are all going to be sectors impacted by tariffs. The chip industry is known for its global supply chain. U.S. automakers could see a buying boom for consumers looking to get ahead of tariffs, but of course the higher prices. GM still down about 2%. Diageo down more than 1%. Foreign alcohol costs could rise by $20 per bottle, according to just one estimate. Of course, there are many more. Now, White House Senior Counsel for Trade and Manufacturing, Peter Navarro, was on Fox News speaking about Trump tariffs and the impact it will have on America. Take a listen.
Let's work through the economics of this. First of all, we're going to raise about $100 billion with the auto tariffs alone. The other tariffs are going to raise about $600 billion a year, about $6 trillion over a 10-year period. And we're going to have tax cuts. It's the biggest tax cut in American history.
All right, we're going to work through the economics with Mike McKee in just a minute, but let's get a little bit more detail on the tariffs. We'll do that with Bloomberg's Laura Davison joining us from Washington. So, Laura, as we count down to Liberation Day, April 2nd, it feels like this could unleash more questions than answers, than clarity that investors have been looking for. I mean, you consider the fact that there's still questions over exemptions, even though Donald Trump said that there wouldn't be any, and of course, what retaliation might look like.
Yes, the White House itself is still figuring out exactly what this plan could look like in its most full form. What the White House says they're doing is looking at all the tariff rates each country charges, as well as all these what they call non-tariff barriers, things like value-added taxes, digital service taxes, and doing some complicated math to figure out what all those tariff rates are. There's some concern within the White House that this is just too complicated of a plan to get done over the next couple days, so that it may be a more scaled-down version, though Trump has said, look, we want to go as maximalist as possible. This will hit all countries. Exactly what this looks like, whether it's tariffs that will go into effect midweek this week or maybe a plan to delay those out over the next couple weeks, that is all still in the mix and has not yet been nailed down at this point.
Certainly a lot of uncertainty. What are Trump's own advisors expected to be telling him, Laura?
So you've got a sort of a range of voices from within the White House. You have people like Peter Navarro who are saying, look, this is going to raise a ton of money. And you kind of see that this is the White House is sort of looking at, OK, how much money can we get for this to pay for things like tax cuts? You have folks like Jameson Greer, who's the U.S. trade representative. He's been arguing for a more orderly approach for, having some of these exemptions, doing a little bit, getting the feedback from the business community. It appears right now Peter Navarro's camp is winning over Jameson Greer's, but there's a lot that can happen over the next 48 hours at the White House.
And beyond. Bloomberg's Laura Davison over in Washington. We thank you for your analysis. And don't forget, even after Liberation Day, this week is also the March jobs report on Friday. So Bloomberg Economics now predicts that the U.S. added 200,000 jobs in March and that the unemployment rate ticked higher. Michael McKee, Bloomberg's chief international economics and policy correspondent, joins us for a preview, including how to think about the Doge cuts.
Well, all of this is going to be questionable in the sense that most of the data we get this week is supposed to give us an idea about what's going to happen going forward in the economy. but none of it is going to do that given what is happening on Wednesday. Bloomberg Economics is not only looking at what happened with the jobs report, but they're looking at the tariffs. And because, as Laura said, there's no idea what these are going to be, the Bloomberg Economics folks are taking a worst-case tariff scenario that we could see tariffs go as high as 35%, and over 4 years, GDP would be 4% lower than otherwise. PCE core rate would be 2.5% higher. If they only did half of that, you'd get 14% tariff rates, cutting GDP by 2% and raising the core by 1.2%. All of that bad for the economy, but basically where we are is what Neil Shearing says from Capital Economics. He says the only certainty about Liberation Day is that everyone loses when tariffs rise. Despite what certain administration officials are saying. So that brings us to the payrolls report on Friday. And Bloomberg Economics is much more, shall we say, optimistic than the consensus so far from economists surveyed by Bloomberg. We get 138,000 from the group. Now, this may change as we get ADP and ISM numbers through the week. Unemployment unchanged and average hourly earnings unchanged. So there's kind of a consensus that we didn't see a big move except hiring got a little bit slower, but I don't think anybody's got a lot of confidence in that because it doesn't really matter after today. It's really what the impact is going to be in terms of the tariffs.
And you're right. I mean, the Friday's job report does feel very far away. When you consider what's coming in the middle of the week, we don't have much time with you, but I need to ask you about stagflation. That seems to be one of the buzzwords of the moment. Goldman Sachs has a great basket of stocks that should perform well under a stagflation scenario. Investors just bidding it up. Should we be talking about stagflation, Mike McKee?
Well, it depends on how you're talking about it. Stagflation is slowing growth and rising inflation. And the problem is the Fed can't do much about that because if they cut rates to help growth, it helps boost inflation. If they raise rates to cut inflation, it helps slow growth. So the question is, how bad would that be? This is nothing like the 1970s, though, when inflation was 10, 12% and growth was down around zero. So it's probably not the same way to think about it as we did before, but it is still a problem for the economy.
Still a problem, and it's an evolving term. Mike McKee, we'll be seeing you a lot this week. Looking forward to it. That is Bloomberg's Michael McKee. And let's keep the conversation going on markets because Wall Street strategists continue to see cracks in the U.S. stock market. RBC's Lori Calvasina says stocks risk sinking into a bear market if the S&P 500 breaks below its mid-March low around 5,500. Let's discuss it all with Bloomberg's JP Barnett. And JP, help us out here because we have Lori Calvasina, as mentioned. We have David Kostin from Goldman Sachs also lowering, again, his S&P 500 year-end target. Are there any bulls still out there?
By the looks of it, not too many. And I guess the name of the game right now is for those who want to be kind of bullish is just like keep the position that they actually have and not outright sell it. But I mean, like, I think we have to rename April 7 from Liberation Day into Uncertainty Day because that's the big topic on markets right now. And that's what you see reflected in both price action and what people are telling you, especially the strategists, that nobody really knows how the effects of the tariffs will play out in the economy. I guess we can all agree that it's not going to be great. But who will be affected most? How long? How painful will this be? Will it be a grind lower, or will we just have a clearing event and we take it from there? And this uncertainty is what is dictating right now the market commentary and the market itself. And you see this in the price action, how fast we have rejected the notion of we found a bounce, we found a bottom, and we bounced from it back to the 200-day moving average for the S&P 500, and now we are back almost to the low levels. So it shows you investors are absolutely unclear what's going to happen, unclear how this is going to play out, and that's why nobody is super keen to stick the neck out.
You know, JP, one question I have is just how low the low is, because in addition to these targets moving all over the place, I want to point out what Mike Wilson just said this morning. He said if those tariffs are universal, that 550 floor could really take a hit and you can go lower. Let's just take a quick listen to what he had to say.
Everybody's looking for a final piece here. This is gonna take time, and not unlike a lot of the other policies that have come out this year. This is what we kind of signed up for, right? I don't think what the president has done has really been surprising. All of the policy changes so far have been growth negative.
Where do investors get in if you don't know the low?
Well, that's a difficult question, right? I would say like two things here. Like, first of all, the first thing is like it will take a long time before we actually see the tariffs and all the government cuts coming into the numbers, both macro and in corporate earnings. So that's probably one thing that investors will look after like quite a lot, like how are the next quarters are going to play out and what is the guidance from companies providing us. And the second one is like kind of the broader positioning theme. Let's not forget that the first wave of the correction that we have seen now was mostly driven by the so-called systematic investors. That's your trend followers, hedge funds in part, volatility controlled, risk parity funds. So they have pushed down the market a lot. But we have not seen like a massive amount of selling from your classic fund manager or even from retail. On the contrary, they were even rather constructive, I would say. So that's another thing that you usually want to see when you want to determine a bottom is like this washout in sentiment, this total capitulation of like risk taking from everybody, and then like everybody has the plate so clean swiped that they can take on fresh risk, and that we haven't seen. So these are the two things. Like the data will take a long time, and then the positioning is the other one that you want to monitor before you decide if you want to go back in.
Yeah, someone's going to have to step in to catch this knife. JP, it's great to speak with you with a tour of the soggy sentiment in these markets. That is Bloomberg's JP Barnett. And with that, let's take a look at these futures right now because, boy, it is just a wipeout, or at least shaping up to be with just about 20 minutes to go until the open. You take a look at the S&P 500, down 0.9% to end the quarter right now. A lot of that pain, as I mentioned, was coming from big tech. That has been the story of the quarter. It's the story of today's action as well. The NASDAQ 100 down a little bit more, and the Russell 2000 also not escaping right now. The Russell 2000 off by about 1.2%. Let's take a look under the hood, though, because we're keeping an eye on vaccine stocks after a top regulator at the FDA stepped down, specifically Peter Marks. He was the regulator who oversaw vaccine and biological drug approvals, stepped down, citing friction with RFK Jr., your new Health and Human Services Secretary. And the sell side, this is negative for vaccine makers, and you can certainly see that in the pre-market action, Sonali.
And, even amid this uncertainty, I'm surprised to say it's a merger Monday. We're seeing a deal. Rocket companies buying Mr. Cooper for more than $9 billion to create a mortgage giant that handles 1 in every 6 mortgages in the United States. Rocket is down more than 5%. It is its second deal announced in a matter of weeks. Mr. Cooper, though, soaring more than 23, almost 24% pre-market. Fascinating deal in the mortgage market.
Yeah, absolutely. And as you mentioned, I mean, we're talking about a 2-time buyer with Rocket just coming out and buying Redfin a couple of weeks ago. So clearly some big ambitions, and they're willing to spend up to make that reality.
Got the data, got the loans.
There you go. All right. Coming up, Elon Musk says his Doge roll is costing him big time at Tesla. We'll take a look at the biggest drag on the Magnificent Seven next. This is Open Interest.
And now to high interest, a look at what's making headlines around the world. Moderna, along with other vaccine makers, plunging today after the resignation of Peter Marks, a top regulator at the FDA. Marks had long overseen approvals of vaccines and other biological drugs, and in his resignation letter, he cited friction with the views of HHS Secretary Robert F. Kennedy Jr., of course, a longtime vaccine skeptic. Now, NYSE Texas is officially open for business, and Trump Media and Technology will become the first stock to list on the exchange. It will trade under the ticker DJT, and the stock's primary listing will remain on NASDAQ. And Elon Musk said Friday that his xAI artificial intelligence startup has acquired the X platform, which he also controls, at a valuation of $33 billion. The deal gives the new combined entity called xAI Holdings a value of more than $100 billion, not including debt. And for Musk, the deal streamlines his businesses and solidifies the relationship between the two companies, which he said, Katie, was coming.
There you go. There's plenty of M&A in this market if you know where to look. But let's stick with Elon Musk and let's take a closer look at Tesla. Musk acknowledged over the weekend that his job at Doge is costing him when it comes to running Tesla. The stock continues a dismal year. It's down nearly 35% over the first 3 months of 2025, down another 5% or so this morning. Here with more, I'm pleased to say we have Bloomberg Technology co-host Caroline Hyde. Caroline, what can happen at this point? What can Musk do? Because you've heard plenty of folks from the sell side say that the brand damage is already done.
And meanwhile, he's saying, well, the shares are quite cheap. Maybe you want to be buying them.
Why not?
He's talking up his stock. This was, of course, actually at a political event. The irony here is that the reason perhaps many feel that there's a drag on the stock is because of his political motivations and movements in the last few months, whether it be in Europe, where we've seen sales plunge across Germany, France, and the EU more broadly. We've also seen sales down over in China. And then here in the United States, he's at a Wisconsin event, all regarding, well, the next people to be put in from a court perspective there. He's handing out $1 million checks. And once again, is that damaging brand? Because many feel that this is in some ways politically affiliated. Now, overall, we are seeing the stock actually outperform other automakers since the tariff news has come in, many feeling that EVs are less susceptible to some of the tariffs that will come, and ultimately that he's able to source much more locally. But it's not undoing what you say is more than 30% sell-off. And then we've got the reports of the fires that happened in Italy, in Rome. Now, we're not knowing whether it is indeed arson or not, but it could well be. And again, that particularly puts pressure on the stock.
I feel like we talk about this a lot, but worth bringing up again. Do investors have confidence in the bench underneath Elon Musk at Tesla? Because if the worry is that he's distracted at minimum, or if his political affiliations are creating havoc on the brand, then who steps up?
It's always key man risk with Tesla and Elon Musk. And actually, that's why there's the anxiety building once more, whether he'll actually get the money he's been promised. Now, remember, they're once again trying to fight to be able to get his enormous pay package to him. Time and time again, the shareholders have voted for him to be accessing those billions and billions. But time and time again, a Delaware judge has overruled it. But their key man risk is significant when it comes to Tesla. They're worried about, him stepping away. But it is hinted that, of course, by May, he's going to be coming back to the fold. And ultimately, he's run plenty of other businesses, theoretically been distracted for years at Tesla, and yet alone the company continues to thrive with further models. So there is the question of whether or not it's just about getting the new models online, the Model Y being upgraded, and the production being more streamlined.
Speaking of things that might be distracting Elon Musk from his job at Tesla, just quickly here, let's talk about what we saw on Friday. XAI buying X. I am so excited to read Matt Levine's take in Money Stuff. But
yes.
What do we know so far? Because I really was not expecting this one.
I think many felt unsurprised by the fact that they are intertwined anyway, X and XAI. Many are wondering what really is the motivation here, ultimately, apart from pumping up the overall valuation of XAI, which seems that Elon's kind of made up himself. He's got one banker across X and XAI, and that's Morgan Stanley.
That's all you need.
He hasn't done another fundraise, so why is it suddenly worth 80 billion rather than 50 billion, as we previously saw? The 33 billion on X is notable because, of course, that's the amount that he basically took it private for back in 2022. That's nice for all the shareholders. They have a growth story once again. Instead of worrying about advertising, they're part of a generative AI play. The question is, what happens to Linda Yaccarino? Does she lead the business unit as it on goes? And will we start to see a pushback on other areas, other companies accessing underlying data from X, which currently is being used for XAI and Grok?
Yeah, and is it an Elon Musk thing, or can there be more M&A in social media networks? We'll keep an eye on it all. Caroline Hyde, we're looking forward to Bloomberg Technology today. Of course, that is Caroline Hyde of Bloomberg Technology at 11 a.m. after this show. Now, coming up, under 12 minutes until the market opens, and we're joined by Raymond James CIO, Larry Adam. He remains optimistic around U.S. stocks. We're going to talk to him about why. This is Bloomberg.
Well, Goldman Sachs is cutting its 2025 S&P 500 target again. David Kossin and his team now see the index at 5,700 points at the end of this year. He says, quote, if the growth outlook and investor confidence deteriorate even further, valuations could decline much more than we forecast. Let's break it down now with Raymond James Chief Investment Officer Larry Adam. He has an S&P target of 63.75. Larry, you've stood by that target even as your colleagues continue to slash theirs. Talk us through the conviction here.
Well, I think one of the main reasons for it is that when we came into the year, we talked about one of the biggest risks was that there was uber optimism. You saw a record amount of people being really positive on the equity market. People were leapfrogging each other, taking the target on the S&P 500 to north of 7,000. And now I think we're on the other spectrum. And people are getting, in my opinion, probably a little too pessimistic on this market. And I think that's a good opportunity to step in, at least start to build positions here in the equity market.
But it seems like a long way to climb back given the negativity we've seen this month. You know, Katie's been pointing out it's been the first quarter of decline since 2022, a very tough year. What brings us back?
Well, first of all, when we want to talk about bearish sentiment, we've had bearish sentiment above 50 now for 5 weeks in a row. That's only happened 2 other times dating back to 1990. In the preceding 12 months, historically, the market has bounced back. And I just think you have to look at what's been priced into the market. And I think that this market is starting to price in some of the worst case scenarios when it comes to tariffs and the economy.
All right, Larry, I am pleased to say that you're sticking with us to walk us through a very, very rocky open, at least if you take a look at futures. That is Larry Adams. Let's take a closer look at these futures right now. As we mentioned, you take a look at the decline right now in the pre-market, currently off by about 1% or so, as you can see, getting close to session lows in at least the pre-market. And once again, it's big tech that is leading this sell-off, Sonali. The NASDAQ 100 off by about 1.4%. The Russell 2000 off by a similar amount, but the Magnificent Seven really have not shown up in any meaningful way so far in 2025.
Yeah, they've been a real dog this year, to say the least. And, you know, the places that people were going to hide to start the year, or at least to broaden out, have also not worked out. Your small caps, for example. People have looked abroad, but now even Mike Wilson saying maybe that trade is stretched. So certainly a lot of concern under the surface that there is a difficulty in finding where to go. You see it in treasuries, but where else?
Yeah, one place,
Gold.
as you mentioned. I mean, treasuries have worked, and we haven't seen that actually play out since 2020. To have a 3-month period where bonds rise and stocks fall, at least in the 60-40 portfolio, you're a little bit cushioned. We'll bring you through the opening bell action next. This is Bloomberg. All right, we are moments away from the start of trading on what's shaping up to be a very, very ugly quarter end. Those losses deepening pre-market. Welcome back to Bloomberg's Open Interest. I'm Katie Greifeld. A lot of red on this screen to my right. As you can see, the S&P 500 down about 1%. Big tech leading the plunge lower. All told, this quarter is shaping up to be the worst quarter on a quarterly basis since 2022. Remember, 2022 was a year where the S&P 500 fell by 19%. It was a very, very ugly one. And so far, there isn't too much to cheer about because few sectors really have been spared in what we've seen so far. I mean, energy is outperforming, but you think about the tariffs that could come this week. Keep a close eye on your automakers, on your chip manufacturers, your drug makers, alcohol distributors, shipping stocks. It all goes on. In any case, you can see right now as cash trading begins, the S&P 500 holding on and building on those pre-market losses. Let's take a check on shares of NVIDIA as well. It's vowed to plow billions of dollars into its U.S. operations. It's down about 3.7% right now. Not exactly helping to lift the stock, but few catalysts have, Sonali.
Yeah, and I'm looking at a stock here that was supposed to be gaining from the likes of tariffs. It has a lot of onshore operations. Not winning today, Katie. Tesla is down more than 5% at the market open. CEO Elon Musk has been saying that his work at Doge is now costing him at Tesla. Remember, he's personally lost $100 billion from Tesla's own stock slide. We're going to stick with the broader market now. We're going to bring in Raymond James, Chief Investment Officer Larry Adams, back with us. You have a more optimistic view than what is being reflected in the market today. We left off a little bit with you talking about where things would start to turn around. My question now is what sectors lead that turnaround?
Well, the 3 sectors we continue to like are technology, the one that you're talking about that's really had a tough go of it here the first quarter. We like industrials, and we also like healthcare. And the main reason we like those 3 sectors is because that's the 3 sectors that have the best earnings growth for this year. And with valuations, at least entering this year, being a little bit more elevated, you need to have earnings growth. And I do think that particularly in technology, as we go through this year, you're going to continue to see them have the power in growth that people have come to expect from them. We're looking for those large cap, mega cap tech stocks to have earnings growth of about 20% this year. That far outpaces the broader market, and I think they'll be rewarded for that type of earnings growth.
It's interesting, Larry, again, to hear you sticking by these calls. I mean, is there any threshold at which you would say, okay, maybe it's time to trim this allocation a little bit. Maybe it's time to think about how we actually build this portfolio. I hear your logic and it makes sense, but at what point would it just be too much?
Well, first of all, we already have taken a lot of this into consideration. I mean, if you look at our positioning, we brought back the beta in our portfolios this year. We're focusing pretty much on large cap equities and mid cap equities, less inclined to be in the higher beta sections like small cap equities, emerging market equities. So we've already taken into account a lot of this volatility. Now, what would make me more nervous about the markets is really looking at what these tariffs actually mean going sector by sector. And we have our analysts go through each and every sector. And sometimes I think you got to remember that the economy isn't necessarily the equity market. And I'll just give you a quick point. If you look at those auto-related tariffs, keep in mind that auto-related stocks in the S&P 500 account for 2.1% of the market cap and only 1.4% of the earnings. So it's not as big as what people think. And by the way, one company, Tesla, represents 1.6% of that approximately 2%, allocation. So I think you have to dig down and look at what is actually going to be the impact on each respective industry and sector. And that's really what we have to continue to do as these tariffs are announced.
To the extent that the economy does matter a bit here to certain sectors, consumer, for example, where a lot of investors are worried that the consumer might drag things down a bit here. They're afraid of inflation. They're afraid of the cost of their car eventually going up on the heels of these tariffs. Where does that make a difference? You have different strategists, say Goldman Sachs, ratcheting up their recession odds here. Does that make a dent?
Well, if we were going into a recession, clearly that would be a big negative for this market. But right now, I will agree that when you look at some of the soft data, sentiment indicators, you are seeing some softness. However, I will tell you that has not necessarily been the best indicator of where the economy is going. And I'll just point out to one particular factor. If you look at the consumer confidence expectations component, historically, you'll hear economists say that when that falls below 80, that's recessionary. And it is true, the last 4 recessions, it was around 80. However, it's reached that level over the last 30 years 15 times. So it's not necessarily a guarantee when it gets to that level that you see a recession. We tend to focus more on what we call high frequency data points. And I still think the consumer's in pretty good shape. When I look at withholding taxes, they're up 8% year over year. What does that tell me? It tells me that there's either more people working or they have more money to spend. But the bigger story is that the biggest part of the U.S. economy, the consumer, has more money to spend. When you look at jobless claims, that's high frequency. That continues to be at historically low levels. And then when we look at our activity metrics, when you look at TSA, that's pretty much flat versus where it was last year, but it's had a big bounce back since January and February. People are still going out to eat. They're still going to hotels. Right. When you look at credit card momentum, that continues to move higher. So I'm not seeing the weakness that a lot of people are talking about with this consumer getting to a recessionary conditions.
Yeah, safe to say, Larry, you're taking the other side of a lot of the doom and gloom that we've been hearing on this program and elsewhere on Bloomberg. But I want to talk about how you're thinking about bonds right now. Bonds obviously caught a big bid in the first quarter. According to a Bloomberg story through Friday, treasuries have outperformed stocks this quarter. We haven't seen bonds rise and stocks fall in a 3-month period since 2020, which certainly tells you something. You're not calling for a recession here, but where do bonds fit into your portfolio?
I actually like bonds. In fact, we call them, you've heard of Mr. Irrelevant. We think bonds are very relevant now for portfolios. And the reason for that is that bonds are doing what bonds do best. They're providing income. And if you look at corporate yields right now, they're at the highest level that we've seen in a decade. So you are getting income from your bond portfolio. And to your point, they are serving as a ballast to the equity volatility that we're seeing in the market. And that's historically been the case. And I think that's going to continue going forward. Now, the big risk out there that everyone wants to talk about is that once the debt ceiling gets accomplished, you're going to see huge issuance. And that's going to take yields higher to 6 or 7%. We are not in that camp. And the reason for that is that we still think demand remains healthy for bonds. And the main thing that we look at is something called the bid to cover ratio. And it continues to be at 2.5. So there's 2.5 times more demand for every bond auction that comes out. And the good news is that trend continues to move higher, not lower. So that's a sign of increasing, not waning appetite for bonds.
Larry, we thank you for joining us today. Refreshing to hear contrarian view in a market full of bears today. That is Raymond James, Chief Investment Officer. Larry, Adam, let's get a look at some of the other stocks moving this hour. We're going to bring in Bloomberg's Nora Melinda for that because, of course, let's start with these vaccine stocks.
Lots going on in the market today. I'm keeping an eye on vaccine makers, including Moderna. It's down more than 10% this morning. This is after Peter Marks, who has been a top regulator at the FDA. He abruptly resigned on Friday, and he's been one of the strongest advocates of vaccines and gene therapies. And in his resignation letter, he cited friction with RFK Jr., saying that and we know RFK Jr. is a longtime vaccine critic, and of course, the current Health and Human Services Secretary. He's saying that truth and transparency are not desired by the Secretary, and so we are seeing a lot of those vaccine makers tumbling on the news, Moderna and Vaxcyte as well. But in another space, when we look at M&A, I'm keeping an eye on Rocket Companies. It's an online mortgage provider, and it's buying Mr. Cooper. That is a mortgage finance company. We've got shares of Mr. Cooper up about 19%, but if you look at Rocket shares, they're down about 10%. And they did have an all-stock transaction. This was a $9.4 billion deal, a pretty straightforward transaction. And we know that Rocket earlier this month said that it would buy Redfin. So lots of deals going on here as we think about the housing market. But lastly, I'm also keeping an eye on CoreWeave. We know that this name has been very topical, but we had analysts who are disappointed by the heavily downsized IPO that we've all been discussing here on Wall Street. They raised about $1.5 billion. The company opened at $39 on Friday, which was about 2.5% below the $40 per share IPO price. And this is really waning enthusiasm as we think about AI stocks. So lots going on here.
Yeah, it's a really tough market for a tech IPO, so we'll continue to watch that one. Really important bellwether. That is Bloomberg's Nora Melinda with your latest stocks roundup. As we watch the S&P 500 hit session lows, we briefly touched a 2025 low, so keep an eye on these benchmarks. Could see some wild trading at quarter end. Now, coming up, we'll have more on that shakeup at the FDA. That conversation up next. This is Open Interest. All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wingstop getting upgraded to a buy over at Jefferies. The firm says that shares of the chicken wing chain are oversold. Next up, we have Barclays cutting Canada Goose to a sell, citing increasing competition and tariff headwinds. Shares down another 6.5% right now. And finally, U.S. Steel getting downgraded over at BMO Capital Markets. The analyst cites uncertainty over the Nippon Steel transaction. Have certainly heard that one before. Meanwhile, we're also keeping an eye on the vaccine makers slumping in the early trade. That's after news this morning that the head of the FDA's vaccines unit, Peter Marks, has resigned. Marks cited friction with Secretary Kennedy, who he was willing to work with. However, he wrote in his letter, it has become clear that truth and transparency are not desired by the secretary, but rather he wishes subservient confirmation of his misinformation and lies. Let's unpack that news with Bloomberg's Rachel Kors-Zhang, who joins us now. And Rachel, some really harsh words for the new HHS secretary.
Indeed. You know, Peter Marks and HHS Secretary Robert F. Kennedy Jr., they know each other. They have a history. They had met about Kennedy's views on vaccines during the first Trump administration. And I think it's become clear that, you know, his views and the views of Peter Marks, who is kind of the top regulator of vaccines and cell and gene therapies at the FDA, were ultimately incompatible.
Rachel, what is the read-through for the vaccine makers? You're seeing, of course, some markets start to react quite strongly. Should they be?
I think there's significant uncertainty, and uncertainty is bad for business. In drug development, it takes several years for these drugs to go through the studies that they need to. VC investors are nervous when there's uncertainty about who's going to be ultimately making the decision at the top. And Marks was certainly an advocate of approving innovative medications for disease areas where there were no other therapies available. And that earned him criticism from some people who thought he was too friendly to industry and too willing to take risks before drugs were really proven. So I think industry certainly worked well with Peter Marks, and I think they're just uncertain as to who could be his replacement in this new administration.
Rachel, we thank you for your time. That is Rachel Kors-Zhang. Now we're going to switch gears because America's largest loan servicer is being bought by the nation's largest lender. Rocket is buying Mr. Cooper in an all-stock deal valued at $9.4 billion. The deal is expected to close in the fourth quarter of the year. Here with more on the deal, Bloomberg's Liana Baker. It's interesting, we were talking just weeks ago about Rocket buying another company, Redfin. Now they're back at the table here with another deal. But this deal, I'm wondering, would it hit antitrust concern?
It's a good question, and it came up on the conference call, but as you know, Rocket doesn't compete with Mr. Cooper. This is entering sort of a new area for them, and if they do compete, it's in smaller pockets. You mentioned the Redfin deal. So Rocket is definitely making a bet that they could be a one-stop shop, that as a home buyer, you could find a house on Redfin, get a mortgage through Rocket, and then get that mortgage service through Mr. Cooper. So it really makes sense that they're trying to line these all up to be just a one-stop shop.
Yeah, and it's interesting. We were talking about it earlier before. Obviously willing to pay up to further those ambitions. Maybe it'll be an early test of the Trump administration's M&A sort of antitrust enforcement.
It's their largest deal to date. And remember, Rocket only went public in 2020. And an all-stock deal is an interesting use of their currency. So be curious what they buy next.
You know, real quickly here, Liana, were these the deals that you expected to see this year? There was a lot of concern about tariffs really putting a wrench in the M&A market, yet we are seeing some deals come through. They just might not have been the deals you expected.
So today is a merger Monday, and what's interesting is that last week we saw a home products deal, home building products. So a few companies seem to be making a bet that maybe the U.S. housing market will come back. And that deal I'm referring to is James Hardie buying Azek last week, so that was pretty large, too.
Right. Yeah, it's interesting. We were also talking about Elon Musk buying X again through XAI. I don't know if you quite count that, but I am curious. I mean, give us a lay of the land, because we had a great big take on the Bloomberg terminal last week about how M&A banker dreams have been dashed. You make the good point that we are seeing some deals come through, maybe not the deals that we necessarily expected to see, but they are happening. But put that into context for us relative to maybe some of the arguably sky-high expectations.
Well, we have seen some activity this year. You know, Johnson & Johnson got the year off to a hot start with a large deal. And you mentioned the CoreWeave IPO last week. That's an interesting one to watch because there's tech companies waiting in the wings to go public, and if they don't think there's a strong bid to go public, maybe they'll sell. We broke news on SoftBank buying Ampere, which was an IPO candidate. So I do think the tech M&A market is a place to look for some activity.
Well, to that end also, you know, you're looking at a NASDAQ 100 right now that's at the lowest levels since September. What does that say about tech valuations? Are potential buyers looking at this and saying, wait a minute, this could be a golden opportunity to buy companies that A, can't go public, and B, are probably a little cheaper?
There's definitely a lot of targets that bankers are thinking about and pitching, and we're just trying to break what happens next. We'll see what else is in that Elon Musk portfolio, all these private companies that he's also trying to amass together. So definitely a lot of things to watch this year.
All right. I'm sure it'll keep you a very busy woman. That is Liana Baker. She heads up our deals coverage over at Bloomberg News. Let's take a quick check on the S&P 500 right now. Breaking below 5,500. We are below that psychological level through our lows for 2025. The S&P 500 currently off by about 1.6%. We'll unpack the worst quarter for stocks since 2022 up next. This is Open Interest. All right, welcome back to Open Interest. Let's take a look at these markets on the final trading day of the quarter. It's ugly out there. The S&P 500 breaking below 5,500, as you can see, now down 1.5% at session lows right now. It's big tech that is leading losses, with the NASDAQ 100 down about 2.2% right now. You take a look at the individual names that are sort of leading us there. As I expected, it's all big tech. You have Apple, Microsoft in the red, as too is Alphabet. So shaping up to be a really ugly session. Maybe we'll get some window dressing as we get closer to 4 p.m., but at least for right now, it's brutal out there. Meanwhile, as I mentioned, the S&P 500 hit its lowest level this year. RBC's Lori Calvasina says that stocks risk sinking into a bear market if the S&P 500 breaks below its mid-March low of around 5,500. We're right there. So let's get straight to Bloomberg's Michael Miska to discuss the quarter that was. And Michael, it feels like we're hearing some more warnings about a potential bear market. We just entered correction territory, and now folks are worried about reaching that 20% drawdown level.
Yes, that's what's going on at the moment. You know that April 2nd was supposed to be like a clearing event. It's not anymore. People see more uncertainty ahead. There's been a lot of strategies cutting their targets for US stocks. Now the risk is that those tariffs will become a really big risk for global growth, that will hit US economic growth. We've seen Yardeni cutting their targets as well today on economic growth for the US. So all this is just like pushing investors to be very cautious. There's a rise in hedging demand, and people are waiting for more capitulation before starting to buy the dip, really.
Speaking of buying the dip, we've been talking a lot about what this low could be in the market. You had Mike Wilson of Morgan Stanley on air with us with Surveillance just earlier this morning, speaking about how that 5,500 level would be the low, barring any universal tariffs that could break that. We broke through it anyways, right? You have JP Morgan calling 5,200. So if you don't hit 50, with 5,200 kind of hanging out there now, right, as that new benchmark, of course it was among the lowest we've seen, then how do people get comfortable until we hit something closer to that?
Yeah, it's very tricky. The problem that we have is we really don't know what's going to happen. So we have a lot of investors that think the positioning hasn't been washed out yet, and they're waiting for just like more drawdown there. What we've seen also in the recent period is you had a lot of cyclicals, whether it's in US or in Europe, that have been underperforming, defensive stocks. The problem is those cyclicals, they're still pricing a very high ISM compared to the current levels. And if you have like global growth starting to roll over, that ISM is not going to climb. And once those stocks start to reprice a lower economic growth, you will have a very big impact on the S&P 500 and on European stocks as well.
Michael, you brought up Ed Yardeni. I want to talk about his call a little bit more. You mentioned he now sees a 45% chance for this current correction moving into a bear market. That's just one part of the call. The other part is that he also sees a 45% chance of a stagflation scenario. Goldman has a basket of stocks that would theoretically do well in such an environment. It's been on fire this year. As you can see, it's the white line there moving higher. What is the stagflation playbook? What does that look like for investors at this moment, Michael?
So what we're seeing is you see U.S. Treasury yields are starting to come down. That's also a sign that U.S. growth is kind of rolling over, or that actually expectations for U.S. growth are starting to get lower. So what you'll have is bond yields starting to come down. The Fed is going to have to step in, and you're going to have like a scenario where the growth is much lower than expected, while the inflation stays slightly, on the current level, and you have like an S&P 500 which is like not going to do great during the year, and those stocks that are keep going to perform.
Michael, we thank you so much for joining us today. That is Michael Musica of Bloomberg. Now let's take a look at what to expect this week, because there is a lot of data. Tomorrow we get the JOLT job openings and ISM manufacturing data, and estimates expect March manufacturing to slow down. Then President Trump will reveal his long-awaited tariffs on what he is calling Liberation Day. Then Thursday, jobless claims and ISM services data. And finally, Friday, it's Jobs Day, and we're going to get the March non-farm payrolls. So a lot of noise in the coming days, but coming up next in the next hour, Katerina Simonetti of Morgan Stanley Private Wealth, and joining us in the C-suite, the CEO of fragrance giant InterParfums, plus the founder of whiskey maker Koval. Stick with us. They're all going to be impacted by what is happening in the tariff story. We're going to talk to them about how they're navigating it all next. This is Open Interest.
All right, we are 30 minutes into a very ugly trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today. And coming up, stock slide as the world waits for President Trump to unveil more tariffs on Wednesday. And a critical jobs report looms on Friday. And executives game out the impact of Trump's tariffs. We're going to speak with the CEO of fragrance giant InterParfums and the founder of whiskey maker Koval. Plus, Larry Fink says protectionism has returned with force. And part of BlackRock's purpose is now to unlock private markets. We're going to give you details of that ahead.
All right, all of that and more coming up. Let's take a quick check on these markets right now. We broke below 5,500, and clearly that triggered, it's been a long morning, triggered a stop of sorts. When you take a look at the levels right now, the S&P 500 rebounding from its session lows was down as much as 1.5%, but coming back a little bit. A similar story if you take a look at big tech, down about 1.8%, which admittedly doesn't look great, but it's not as bad as just a couple of minutes ago. And meanwhile, that bid in the bond market lessening a little bit here. 10-year Treasury yields down about 4 basis points. Let's unpack all this action now with Katerina Simonetti. She is Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager. Katerina, great to have you with us. I want to get the on-the-ground mood, the conversations that you're having with your clients, because we're hearing a lot of doom and gloom from the sell side, from investors. What do your conversations actually sound like right now?
Well, thank you. It's a great question, especially that considering that we're negative for the year as we're working our way through yet another market correction. And this seems to have been a pattern from the beginning of the year. There's so much news, there is so much headline risk out there that we see this series of corrections and rallies, which of course could be extremely unsettling for investors. But we can't forget that this is not just all about tariffs. We also are dealing with the fact that Fed is pausing the interest rate hikes, and there is Doge, a new immigration policy. And of course, the fact that the current administration does not seem to be as supportive of this market as many investors thought that would happen. And so this comes as a bit of a surprise. So what we're seeing right now is this combination of short-term positioning, where we're advocating taking advantage of some of the buying opportunities, but also safe havens for the long run to make sure that, that investment portfolios can get through this volatile time.
I want to harp down on the point about rate cuts for a moment here, because you are seeing the Fed's funds futures pricing in more than 3 rate cuts now in through December. And you also have Goldman Sachs raising their odds of a recession. Are you concerned here about a meaningful weakening of the economy that would require those rate cuts?
Well, currently, we're not yet pricing in the recession, but sometimes this turns into somewhat of a self-fulfilling prophecy, where stock market continues to decline at the levels that we're seeing, where these corrections like we are seeing today is something that is unsettling investors, and it makes them feel uncomfortable with being in the market. This negatively affects consumer confidence and eventually could lead to the recession. So while we're still of the mindset that majority of the growth for this year is going to come towards the second half of the year, this certainly is something that in our bearish scenario we're pricing in.
Well, Katerina, you made the interesting point that it's not just tariffs that this market is worried about. And I go back to Lori Calvasina's note from this morning from RBC, and she writes that any certainty on tariffs is unlikely to rewind the clock and take investors back to a time in which economic and national security weren't obviously intertwined. So who knows what we'll get on Wednesday? Really, it seems like it'll create more questions than answers. But even if we do get that clarity, I mean, it seems like it's too early to time the bottom necessarily.
Well, absolutely. And on one side, we are also dealing with the fact that the earnings have been revised to the negative in a broad sense, but not everywhere. There are certainly sectors that, despite of the tariffs, despite of the news, are doing well, and we're seeing positive earnings revisions and are positioned quite favorably. So on one side, there is a trade on these dips, right? Something like, the names that we'll like, the Magnificent Seven, where the earnings revisions have been actually improving. But in the long run, we absolutely are advocating positioning in quality and safety in sectors like financials and industrials, materials. Industrials, for example, are actually showing positive earnings revisions, and is the sector that potentially one could say is not going to be affected by tariffs at all, as industrial development will continue regardless of what is happening on the tariff horizon, but also the software and consumer services and, I already mentioned financials that tend to do well in the higher interest rate environment. So there are safe havens out there with high quality dividend paying stocks, and that's exactly what we're advocating to our clients.
Now, where do you go to hide? You mentioned this in the stock market as well, but we've been talking about fixed income. A lot of people looking at the bond market to go. A lot of people looking at gold. Do you recommend that, given the bid that we've seen in both of those places so far?
Well, gold has been a traditional safe haven. One of the potential issues there is when we look at the performance of gold over the last couple of years that have been a significant run up, and in my personal view, it's a non-yielding asset class. So positioning in the portfolio of the gold could be on one side, making investors feel really safe. On the other side, they're lacking income, which is something that they could pick up on the fixed income side. And we still have the benefit of being in the high interest rate environment. And sometimes we forget that it took us 20 years to get to where we are on the rates right now. So whether there is money in cash that is earning higher rates than we historically have seen, or in a diversified, high-quality fixed income portfolio, investors do have ability right now to position the fixed income side of their portfolios in a way that they can enjoy higher rates for longer, even once Federal Reserve continues or resumes rate cuts. They're going to be receiving these higher yields in the investment-grade bonds specifically.
Yeah, it's interesting, Katerina. We were just speaking with Larry Adam about 30 minutes ago. He's a stock bull, no buts about it, but he also likes fixed income. So there's plenty of bullish cases for bonds right now. I want to go around the world, though, and I want to talk about Europe, because one of the amazing things that happened this past quarter was the stock 600. It outpaced the S&P 500 by nearly 17 percentage points this quarter in dollar terms. That would be a record outperformance. Katerina, how do you feel about Europe right now? Are you chasing this rally, or do you share some of the skepticism that we've heard on this show?
Well, the European trade is very much driven by the fact that potentially there might be an end to the war in Ukraine and the implications that it would have, the positive implication that it would have for European economy. Now, by no means are we there. And it's not a certain thing that it will happen, but European stocks seems to be pricing for this. Now, in our view, we actually are seeing US coming up as a more of a buying opportunity versus Europe, especially fueled by the weaker dollar and the positioning of US stocks that are coming down in value right now versus that run up that we saw in the European market during the last 3-4 months.
Katerina Simonetti of Morgan Stanley, we thank you so very much for joining us on this Monday. Of course, a crazy week ahead for investors, but let's get a look at the stocks moving under the surface this hour. For that, we're going to bring in Bloomberg's Nora Melinda. We're keeping an eye here on Tesla. Another brutal day.
Another brutal day. Lots moving under the hood this morning as we see a lot of names in the red here. But we have Tesla that's leading its Magnificent Seven peers lower. And this is all as Wall Street is sitting on the edge of its seat ahead of Wednesday, which we know is a really big day. And in terms of what Trump is going to do in terms of tariffs next week. But also we do have this underlying skepticism that a lot of people are having about where Elon Musk's attention sits right now in this time period where he's really politically involved. So we are seeing Tesla to be a laggard amongst its Mag 7 peers. I mean, when you look at the what it's doing in terms of performance year to date, we see Tesla shares that are down almost 40%, but that's compared to Mag 7 stocks that are down about 17%.
It's interesting. We're watching all of the Magnificent Seven stocks now down for the year. Kato, we saw Meta holding on for a while.
Yeah.
Didn't last.
It had been outperforming, to your point, but boy, it has just been a brutal market. Brutal market in some of the highest flyers, including in crypto, Sonali.
Yeah, let's look at that because we were looking at crypto lower and crypto linked stocks. What have you got?
It has really fallen from its highs as we are looking at crypto, just trending lower. It's continuing to trend lower. And what I'm looking at today are crypto exposed stocks. We're seeing them slipping as Bitcoin continues its trend lower. We're seeing crypto traders that are now flocking to the options market as they're hedging against further price declines. They're really just seeing investors that are looking for a safe haven place to land. And so we are seeing a lot of these crypto exposed names falling on the news.
Yeah, it's interesting to hear that crypto traders are buckling up. Of course, volatility is the name of the game in crypto. Let's talk about vaccine makers. You were speaking to us about this a few minutes ago, but you take a look at Moderna just having a miserable Monday, down about 11%. What's going on at the FDA?
Yeah, I mean, there's lots going on there. We had Peter Marks, who has really been a long-term advocate for vaccines and gene therapies. And so he actually abruptly resigned on Friday. This was unexpected, but he is really calling out some ongoing friction that he had with RFK Jr. And that is really just roiling markets as people are really interested to see what a lot of these vaccine makers will be able to do moving forward if they don't really have somebody really pushing behind it.
Nora, we thank you so much for keeping an eye on everything moving under the hood. That is Nora Melinda of Bloomberg News. And, just taking a quick look here at the S&P 500. It's not as bad as we started the day, Katie.
Yeah. It's interesting. If you take a look at the intraday chart, we were talking about 5,500 as a level to watch. That's what Lori Calvasina told us to watch. We just broke below it and then, like a rocket, have shot straight back up. Of course, it's just intraday, so who knows? But you have to imagine that maybe some stop losses were triggered around 5,500. It was a very important psychological level.
Still is. And let's see if we can end the day there. Of course, Morgan Stanley's Mike Wilson, another person keeping an eye on that level. We will keep an eye on it too. But coming up, we're going to keep an eye on BlackRock because Larry Fink is vowing to open up the private markets to the masses. We're going to talk about his dream next in the Wall Street Beat. This is Bloomberg. And now to high interest, a look at what's making headlines around the world. France's far-right leader, Marine Le Pen's presidential ambitions are being dealt a potential death blow. Le Pen was convicted of embezzlement and barred from running in the next election in 2027. Le Pen was also sentenced to 2 years in prison. The ruling may open a power vacuum within the French far-right. And Elon Musk is acknowledging that his job as head of Doge, President Trump's effort to cut the size of government, is costing him a lot when it comes to another big job, the CEO of Tesla. Musk's political activities have led to a 45% drop in Tesla shares since their peak last year, causing his personal wealth to decline by over $100 billion this year. And Lewis Morton, who specializes in the highly levered bond basis trade, is leaving Eisler Capital. It's the latest in a string of departures from the hedge fund. Morton was among the firm's top moneymakers, generating hundreds of millions of dollars in profit in 2022 and 2023. He is the second star to leave the firm so far this year. Adrian Delatre, another highly profitable trader, left earlier this month. And boy, do I wish Matt Miller were here. I love to talk about that basis trade. But for now, we are going to talk about the Wall Street Beat. BlackRock CEO Larry Fink is planning on opening up private markets to millions of everyday investors. It is the next step to transform BlackRock into the first firm to manage money at scale across traditional and alternative assets. Joining us now, private equity reporter Allison McNeely and Bloomberg Intelligence financials analyst Neil Sipes, who covers BlackRock closely. Allison, I want to start with you because this annual letter from Larry Fink was quite poetic. He talks about a prosperity flywheel, and he opens the door to unlocking private markets. Now, one holy grail of that would be to bring in private assets into the 401k plan. You wrote about this recently. Is this a likelihood in the next 4 years?
It's certainly a realistic possibility. Larry Fink sounds like many of his large asset management peers, whether they're on the alternative side or traditional side, in sort of talking about the necessity to bring private assets to individual savers like 401k retirees. Really, there's an industry-wide push on both the traditional and alternative side to get access to those funds.
So, as Sonali spelled out, there's a lot of poetry in this letter. Of course, Fink took his time to wordsmith that. But I want to talk about the cold capitalist reasons why BlackRock might be interested in really expanding aggressively into private assets. You know, they have trillions of dollars when it comes to ETFs. A lot of them are passively managed. It's not like you get very fat margins on passively managed index funds.
No, you certainly don't. And that's a trend you've seen across broader asset management is, of course, fees declining. Most prevalent is, of course, those passive products, the beta type products. So ultimately, when you think of BlackRock, that's what you think of, that traditional legacy business that's grown to nearly half its franchise. But obviously, the other side of it is assets near 12 trillion now. The fees are the different story for those passive products. And really, when you look forward, where the fees are going to be is those alternatives and private market space. You think about passive products are 25% of all global assets under management. Alternatives are also a quarter of assets, but alternatives are half of revenue, and passive is less than 10% of revenue. So you think about the difference in the story there. It's no secret why they're interested.
What's interesting to me, the many ways they've tried to do this. You and I, Katie, have covered a lot that private credit ETF from Apollo and State Street. For example, there are interval funds being offered by the likes of JP Morgan and slowly everybody else, it seems like. Allison, you've covered these products so closely, the interval funds as well. BlackRock now putting private assets into the model portfolio, getting access to financial advisors as well. What's taking off? What are the ways that are actually working to retailize private markets?
So far, we've seen products that offer quarterly liquidity as opposed to daily liquidity.
Those interval funds.
Yeah, interval funds be the ones that are kind of getting the most uptake right now, I guess. That's largely because those structures are already in place and have been in place for longer on the wealth side. But certainly everyone is working quickly and furiously to try and solve this daily liquidity problem or question, I guess, to say, you know, what happens to some of these assets that, you know, are not generally valued on a daily basis, are not bought and sold on a daily basis. How do you put those alongside stocks, bonds, other daily liquid assets? That's a puzzle that I think the industry is still trying to figure out. There may need to be some regulatory changes or at least some regulatory clarification in order to make those products really take off.
Well, we saw an early answer from State Street and Apollo, but if you take a look at interest from actual investors, I mean, PRIV is the ticker for that private credit ETF. It's only seen 2 days of net inflows. It launched over a month ago, so it seems like investors taking a wait and see approach. As Allison mentioned, though, you have a lot of the brightest minds in finance trying to solve this problem. It's interesting that we haven't seen a pile-on from issuers. BlackRock, for example, hasn't filed for a private credit ETF. I mean, how do you at Bloomberg Intelligence think about these different wrappers as we talk about this really aggressive push by the likes of BlackRock into private assets?
Yeah, I think what we hear from most managers that we follow is they want to be vehicle agnostic. They want to be able to provide the solution to the client, regardless of whether it's a mutual fund, interval fund, ETF, whatever that might be. The one that we've seen rolled out recently has a 70 basis point expense ratio. So we're obviously talking about a different fee structure when you think of a traditional ETF. Again, that speaks to the attractiveness of the product for the manager. We haven't necessarily seen, as you noted, the uptake yet. We're still in the wait and see period. I think that's a big hurdle right now is sort of the education of these products, how we're going to get that liquidity, how advisors are going to explain that to the end client as well. And ultimately how that's going to fit in the broader portfolio where you have Larry Fink talking about the 50-30-20 rather than the 60-40.
You know, it's interesting. I mean, it seems like even though we haven't seen a lot of inflows, when I talk to both Anna Paglia at State Street, she says she's having a lot of conversations about PRIV. I've also spoken to a lot of folks who actually put together model portfolios, and they say that they're fielding a lot of questions about PRIV, but no one wants to necessarily be the first to come into this still untested wrapper.
Yeah, and it's part private assets and it's part public assets.
True.
Of course, whether you're Apollo or KKR or anyone of the like, you're going to have that acknowledgement that there is a return drag relative to the private markets because you're not going to get the whole thing yet, at least for now. Allison McNeil, thank you for all of your reporting. Neil Sipes of Bloomberg Intelligence, we thank you both for your time. And Katie, I would just point out that it's a really interesting letter from Larry Fink. I would recommend people read it. You can talk a lot about private markets, but if you're into tokenization, that's a big word for some people. You can take a read about his views there at length. Now, still ahead, CoreWeave, you might have seen what happened there. They had picked a tough time to IPO. The stock is falling on the second day of trading. It's been a rough ride at the open. We're going to give you details on that next. This is Bloomberg Open Interest.
All right, it's time now for Social Climbers. The company's making waves this morning, and first up, it's been a rough start for CoreWeave, to say the least. The cloud computing provider made its public debut on Friday, and shares continue to struggle in the wake of its downsized IPO. Analysts on Wall Street call the debut disappointing and discouraging for the overall IPO market. Next up, the online mortgage provider Rocket is acquiring Mr. Cooper in an all-stock deal valued at nearly $9.5 billion. The deal will create a mortgage giant that handles 1 in every 6 mortgages in the U.S. Remember, earlier this month, Rocket struck a deal to acquire Redfin. And finally, we have Uber and OpenTable teaming up to integrate their transportation, delivery, and dining reservation services. For users, this means you can book a reservation and a ride at the same time. Meanwhile, let's get a check on these markets. Of course, we broke below 5,500 on the S&P 500. We're above it right now, but still down 1.2%, on track for the ugliest quarter since 2022. A lot of that pain has been coming from big tech, and you can see that today in the NASDAQ 100, down about 2% or so. That's sending a bid into the bond market, down about 4 bases on your 10-year yield as we wait for Liberation Day, for tariffs coming up on Wednesday. Much more ahead. This is Bloomberg. Well, President Trump's tariffs loom over companies with an uncertain week ahead concerning the duties to come. For firms like InterParfums with operations in Europe and the U.S., that uncertainty is a big problem. InterParfums specializes in developing, manufacturing, and distributing prestige perfumes and cosmetics. I'm pleased to say that we're joined now by the chairman and CEO, Jean Madar, right now in studio. Great to have you with us.
Thank you. Thank you for having me.
So April 2nd is the big day that's circled on everyone's calendars, yours included, I'm sure. You don't own manufacturing facilities, but you do source fragrance components from around the globe, including from China. And with that in mind, how do you begin to plan around President Trump's tariffs and what we may hear on Wednesday?
Yeah, Wednesday will be a big day for a lot of companies. For us, it's difficult to say that we are ready, but we have some plans. Basically, for a while, we have decided to make in the US what sells in the US, make in Europe what sells in Europe. It sounds simple. It's not that simple, but to complicate the problems, even if a product is made in America, filled in America, a lot of components come from other countries. Plastic or metallic cap or label could come from China or Europe. So definitely tariff will be an issue. But I will say that because eventually the finished product is filled where it's going to be sold and consumed, I think it's less of a risk for IPAR.
Does it create a pressure in terms of costs, both for the company and the end consumer?
Yes, it creates pressure for sure. We are going to try to absorb most of the cost because we have efficiencies and we think we can absorb up to 5 to 10 points. But eventually, if on Wednesday we hear some crazy numbers, we'll have to pass it on, some of it at least, to the consumers, which is the last thing we want to do. We think there is a limit to the elasticity American consumer can absorb. In the last 2 years, where there was no problem, prices went up already, so we saw pricing. I think we'll have to be very careful to not go crazy with a price increase.
So there's so many unknowns right now, but I want to get a little bit deeper into pricing strategies, particularly when it comes to different markets. You mentioned that, you know, what's sold in the U.S., a U.S. brand, it's going to be made in the U.S. The same goes for Europe. But I have to imagine there's some brands that, you know, sort of span different regions. So how do you start to think about that?
As you know, we have a very large portfolio of brands. We go from very high-end like Van Cleef & Arpels to very democratic or lifestyle like Guess or Lacoste. A price increase for a product like Van Cleef that retails for $300 is less important than for Abercrombie and Fitch that retails for $50. So it's not the same for all the brands, I would say.
One of the issues we're seeing is many of the brands that we speak to, companies we speak to, they don't always have the flexibility to absorb the cost. And if you're watching consumer prices potentially go up, do you worry that especially some of the brands like Lacoste or Guess, as you had mentioned, would face some pressure, given the consumer pocketbook now has to choose?
I think that fragrance, this category, this particular category, is a little bit more protected than others in the beauty world. I will say that fragrance is still affordable luxury, so it became a necessity. It was not a necessity before, but today men and women want to wear their fragrance every day. It's important for it's emotionally very important. So I think that even if they have to pay a little more, I don't see too much pressure on sales. We do not expect sales to go down.
That's right.
And by the way,
yeah.
when, if you look at the first quarter in the US, the market is very, very robust.
Well, it's interesting. I was actually going to ask the inverse of your question, whether you're seeing any sort of trade down in your brand portfolio. But it sounds like what you're saying is, you know, those higher end consumers, they're going to buy the scent that they like.
Yes, absolutely.
Interesting.
We see a premiumization. People are going for more expensive fragrance, more concentrated fragrance. Even younger people are looking for more sophisticated juice, and they will be willing to spend more than $100 for a bottle of perfume.
And I am curious how people are actually buying your fragrances, what the breakdown between in-store versus e-commerce looks like. It feels like every industry, every type of luxury and beauty is sort of moving online, but fragrance, I feel like you kind of want to smell it.
That's what I thought.
Yeah.
But COVID came, and we saw that people couldn't go to stores. They couldn't go to Macy's to try new fragrances. And we saw a huge increase in sales on e-commerce. So people are willing to buy products that they have not smelled. We have to do a good job to tell the story, because we are storytellers, and create this contact, describing ingredients, describing the way the fragrance is made. And we have today an Amazon business growing by more than 50%.
There you have it. Jean, it's so great to speak with you and get your perspective ahead of April 2nd. That is Jean Madar, CEO of InterParfums. Meanwhile, let's get a check on these markets right now. The S&P 500, it's off session lows, still down about 0.9%, a pretty even split. If you take a look at the gainers and the losers right now, you have 274 stocks in the green, about roughly that amount, a little bit less to the downside, but still you can see that the direction right now on the S&P 500, on the NASDAQ 100, and even in bond yields right now, Sonali, is clearly lower.
We're also going to take a look at the stocks moving under the surface this hour. We're going to bring in Bloomberg's Denita Sekova for that.
Let's start with Canada Goose. We're talking about that high-end consumer, and this is really one company where we're seeing a lot of pressure. Barclay has downgraded it today to underweight. The stock fell as much as 9%. Some of the losses are coming off. But what we're seeing is that there is a lot of uncertainty, and the macro and of course, tariffs are a big problem here. We had Goldman Sachs actually issuing a report recently saying that Canada Goose will be one of the retailers who will be hit the hardest by those tariffs. One big stat that comes out of this is 80% of its sourcing, it's from Canada. And we've obviously talked about those 25% tariff. You can imagine that this is a big hit. On top of those macro forces, the last earnings report we had from the company was disappointing when it comes to sales, margins, and earnings. So there is both the fundamental issues and the macro issues. Barclay is also cut their targets. This is the second time they do it this year. And if we look at all the analyst calls, there is actually only one buy call for Canada Goose. So there is a lot of pressure on the stock, which is already down about 20% year to date.
Yeah, not to add insult to injury, but we're almost in April, so people aren't necessarily buying jackets right now. Some seasonality issues there as well. Talk to me about Celsius, because Celsius having a huge day right now, up by more than 6%, Anita.
Yeah, Celsius has been having a great streak. Of course, we recently heard about the acquisition of Alani Nu. So the jump today comes after Truist Securities upgraded the stock, and they're saying, this is very interesting, that this is very strong for the company because they have a very strong women audience. Obviously, the competition has been growing. They're competing with Red Bull. Everyone is trying to do kind of a healthier version with less sugar and all that. So as the competition is heating up, women in energy drinks are becoming obviously a very, very important group. The stock was down 50% last year, but it's up 35% this year. So you can see that acquisition is really a change for the company. There is a lot of optimism. And when you look at analysts, we were seeing a lot of upgrades. So, you know, women in energy drinks are helping to drive the companies up.
Sonali is one of them. You love Celsius.
Katie's looking right at me. I do use my Celsius before a workout here and there and before the show very often. Anyways, Denitza, U.S. steel, we're taking a look at it still dropping today.
Yeah, it's down more than 3%. What we saw is another downgrade. And of course, we're talking about that. That's something President Trump has been actively looking at and talking about. And that's why we're seeing the downgrade from BMO, which is saying that there is just too much uncertainty around the stock. And what we're seeing is actually they're upgrading Steel Dynamics. So clearly they're seeing other companies that are more interesting in that space. Of course, what we're seeing here is Nippon Steel has been trying to acquire U.S. Steel, but that was just postponed, and there is a lot of uncertainty, and the president says that he is against full ownership. So we're yet to see what happens.
Yeah, just the deal that never ends there. We appreciate the update. That is Bloomberg's Denitza Sekova. Now, coming up, whiskey caught right in the middle of the global trade war. We'll speak to Sonat Birnecker Hart, Koval Distillery president and founder, next. This is Open Interest.
There is an imbalance with trade around the world, and we do need to level the playing field a little bit. When you talk about Canadian tariffs, my bottle price, that is $49 here, $75, $80 in Canada. Wow. But we don't do the same thing for Canadian whiskey that comes here. I think that if we're going to be charged more taking our American spirits into other countries, we should match that when they're coming here.
That was Fawn Weaver, Uncle Nearest founder and CEO, speaking with us earlier this month. Now, whiskey is caught in the crosshairs of the potential global trade war. The EU is set to impose tariffs on U.S. whiskey on April 13th. For more on the move, we are joined by Sonat Birnecker Hart, president and founder of Koval Distillery. Sonat, you think about the push forward of those EU tariffs. What do you think this signals ultimately, and do you think that they're up for play?
I sure hope so. It's definitely something that we've been living with, these looming tariffs that was supposed to be April 1st. Now it's been pushed back to April 15th. We consider this hopeful. Obviously, we would like there to be a resolution in which we're 0 for 0. That's sort of where we were with regard to the EU before, and that's where we would like to remain. But, jury's out. We've had to, consider the possibility that these tariffs will go through as well. So we're preparing for both scenarios.
Well, Sonat, let's talk about those preparations. I mean, have you been looking at alternative suppliers, alternative markets? How do you possibly sort of game plan what could happen?
Well, it's like playing chess. You're looking at all of the options on the board. And certainly, you need to be thinking multiple steps ahead because you don't know what moves are going to be made against you. So we've been planning on a number of different levels. One of the things that we've done is we've shipped more product over to hopefully weather the storm for a while. We've had to go into a mode of speaking with all of our partners abroad and reassuring them that we are committed to the market and that, all of the many years, decade that we've been in certain European markets and more for others, are going to be honored, and that we're going to continue to market in those markets, that we're going to continue to go to those markets and support our brand. You can't really just ship product abroad and hope for the best. So there's always a partnership, and there are always activities that need to follow the sale. And that's what they're kind of worried about. They're worried, are you going to be able to continue your marketing efforts? Are you going to be able to continue to come in and do the trade shows and do the events? And these are all very costly things to do, but they're what you need to do as brand support. And, when the costs go up, the assumption is brand support will go down.
Sonat, what is your biggest concern here? Of all the things being discussed right now by the Trump administration, what has the potential to have the biggest lasting long-term change to your business?
I would say that we've been experiencing many big events that have caused long-term change, and this would just be another one of many. We had first the original sort of tariff issues, then we had the pandemic, which certainly has affected things in a long-term way. And then now we've had this, the looming possibility of more tariffs and even higher, the threat of going to 50% with Europe, which is one of our, best trading partners for the United States for whiskey. I believe that about 40% of American whiskey and certainly spirits go to Europe. So this is definitely a concern for us. These are markets where we've invested a lot of time and energy. But what I really worry about most is that our industry, and particularly the craft industry as well, which has developed over the course of the last, decade and a half, is very global. You have craft brands that are trying to find their niche everywhere. And so if it becomes more difficult to remain on the shelf in a particular European market, there are going to be plenty of other craft brands saying, try me. And so these try me's are what I'm most worried about, because they're my competition, and I need to remain on the shelf and keep reminding our customers and our fans and our distributors that they really like us, and that they should stick with us.
So keeping shelf space, keeping that market share, that's top of mind for you. I do want to talk a little bit about your pricing strategy going forward. We were just talking to Jean Madar of InterParfums. How many times can I say this French name? But he was saying to us, Sonat, that he's very concerned about, trying to keep prices stable. That obviously is a very difficult thing to do. What potential plans do you have to try to keep prices at close to the levels that they are now?
Well, we are not going to be able to raise prices. Certainly not in the current market, here or abroad. I mean, I would say that, to raise prices is to price yourself out of the market. And also to raise prices would be to increase uncertainty with our distributors and our retail partners who think that, oh, they're raising prices. Oh, they might not be supporting their brand. Oh, maybe we should try somebody else. So that's not something I want to happen. So we're going to have to eat whatever costs there are and hope to weather this storm, to maintain these relationships and to keep hold of our shelf space, which is very important to us. But in order to do this, we're going to have to consider, maybe where there are price cuts, maybe where we need to focus on other markets to increase business. We were relying on Europe to some degree as a growth market. It certainly was a growth market. And after the tariffs abated the last time, and after, the effects of COVID started to, go away and people started going back to hospitality, we started seeing an increase again. And certainly, when you look at statistics for American spirits at large, we saw a huge increase in exports imports, after the tariffs and also after, COVID sort of went by the wayside. And this is going to affect it again. So we need to be looking globally as a craft brand that relies to some degree on global trade for growth. And I would say this is true for a lot of craft brands that see the global market as a way to gain opportunities. We need to be looking for these opportunities wherever they are. So our eyes are wide open.
Sonat, we thank you for joining us this Monday morning. Of course, that is Sonat Birnecker Hart of Koval Distillery. Of course, founded in Chicago in 2008, another business that is going to be impacted by those tariffs, small and big. Katie, we're keeping a look at. Now, coming up, President Trump threatens secondary tariffs on buyers of Russian oil if President Putin refuses a ceasefire with Ukraine. We're going to get the latest out of D.C. next. This is Bloomberg.
Well, President Donald Trump isn't ruling out a third term in the White House. He told NBC in a phone interview that, quote, there are methods that would allow him to do so. Joining us now from Washington is Bloomberg Balance of Power co-host Kayleigh Line. So, Kayleigh, we don't have a ton of details, but my understanding is that it takes a couple of years and then some to change the Constitution.
Yeah, he can't run for a third term as president per the 22nd Amendment to the Constitution of the United States, Katie, and it would require a 2/3 majority of states ratifying any change for that to actually change constitutionally speaking. Now, the other methods that he might be referring to here include notions that maybe Vice President J.D. Vance could run for president instead and then hand the reins over to Trump, who would take things over from there. But he does say that while he's not joking about the idea of seeking a third term, that is not something he is focused on right now. Right now, he's focused on his current term, which, of course, is dominated this week by his efforts around tariff policy, as well as seeking a ceasefire in the war between Russia and Ukraine.
I want to also kind of switch gears just a little bit here, Kayleigh, and talk about the elections that are going on in Florida as well, because, of course, there are a lot of investors and Americans looking around and seeing what the tone is on the ground and what the jury is on the Trump administration. And that's a little bit of a signal, isn't it?
Yeah, in Florida, specifically the 6th district around Daytona Beach, the seat that was vacated by the National Security Advisor Mike Waltz when he joined the administration, things are a lot tighter in what should be a safely Republican seat. This is a district that Donald Trump won by 30 points in November, and yet the Republican is only polling a few points ahead of the Democrat, who has raised millions of dollars for this race. So that is one of the reasons why you see the Trump administration getting a little bit more nervous about the House majority, hence the decision to pull the nomination of Congresswoman Elise Stefanik as UN ambassador and keep her in the House to try to push his legislative agenda through. The other race to be watching tomorrow is actually the Supreme Court race in Wisconsin. That is where Elon Musk spent his day yesterday, as he put a lot of money in for the conservative candidate for a justice, knowing that the Wisconsin Supreme Court right now has a 4-3 liberal majority, and it could flip depending on the outcome of tomorrow's vote.
Yeah, $14 million, I believe, that Elon Musk put behind that race. It'll be fascinating to see how that plays out. Kayleigh and Joe Matthew will be all over it on Balance of Power. But that does it for Open Interest. We'll see you tomorrow. This is Bloomberg.